Hey guys, what is going on? Welcome into the video. So we had a game-changing move in the stock market last week, and I have a ton to get into in this one. We're going to take a look at what played out from last week's catalysts and what that means for the market moving forward, and then go over a bunch of trade ideas for the week and weeks ahead along with that. Let's go ahead and get on into it. Last week we talked about how the week ahead would likely dictate how the end of the year plays out for the market, and as it looks right now, we got just that. So the CPI report came out on Tuesday morning, and it was actually a very bullish report for the market. The CPI came in 0.2% below expectations, and as we can see, the initial reaction supported just that. But like we've been talking about on the channel, the inflation going down narrative, so the stock market has bottomed, is pretty much coming to an end. Almost every analyst is estimating that inflation is going to drop like a rock moving forward, so it's no longer a surprise to the market when this happens. So after that initial pop, the big money took this as an opportunity to sell the news and book profits because there is super bleak outlook moving forward that we're headed into in Q1 earnings season. The S&P gapped into that 4150 to 4175 supply zone that we've been talking about and started a pretty violent sell from there. And after no big surprises from the FOMC meeting, the market continued its sell into the rest of the week and now has broken down from the recent consolidation range. So what we have to ask ourselves now is, has the next leg down started for the market, or could this be another fake out? In this consolidation range on the futures chart, we have seen multiple fake outs, so we got to keep that in mind, of course. So the core range has been between 39.12 and 40.50, with a few upside extensions at 41.10, 41.50, and 41.80. And also on the downside, 3900 is an important level just below. So we closed below that range this week, so the market is now guilty until proven innocent, aka reclaiming above a key level to potentially set up a false breakout if that can play out. So for bulls to have a shot here, 39.12 is the key level that needs to reclaim above next to potentially start a move back to the upside. That was the spot it bounced off of multiple times within this range, and once it broke down on Friday, it got rejected on the back test of that level. That now becomes key resistance and the upside trigger if it reclaims back above. On the downside, I have important levels at 38.70, 38.20, and then 37.50 to 37.75, and that 37.50 to 75 is the strongest demand zone and a level that started multiple rallies from, including that massive 5% plus move from October CPI print. That zone would be a good first target for this new downtrend if it continues lower and fails to reclaim back above one of those key levels to the upside. Alright, so now let's take a look at some of the mega caps and market leaders to give us more of an opinion on where the broad market could be headed next. So first up is Apple, ticker symbol AAPL. We've been talking about this major trend line for weeks now, saying if it broke below, it could start to get real ugly for the stock market. It broke and closed below this on Friday, which is a major warning for the stock and the market as a whole, as it's the largest percentage holding in most indexes. The setup here looks a lot like Tesla when it started its breakdown, and well, we all know how that one has played out since. It could certainly see some more consolidation here next, but the technical outlook is looking very bearish for Apple moving forward. It's breaking down from this multi-year head and shoulders pattern and also breaking down from the shorter term head and shoulders pattern below that trend line. 52-week lows look likely to come before long and could visit the low 100s before this is all said and done. Nvidia, ticker symbol NVDA, is also one that is looking pretty toppy here. It failed its breakout above the 200-day moving average this past week along with its long-term trend line. False breakouts are dangerous because there are always breakout traders buying once it breaks out, and if it fails, those new buyers end up selling, which just pretty much adds more fuel to the fire where supply greatly outrules the demand from buyers. If this breaks below this trendline support, look out below for this stock and the semiconductor sector as a whole. Microsoft, ticker symbol MSFT, was a name that also was showing recent relative strength, but it's now looking real bearish once again. It rejected right off the 200-day moving average and failed to break out above 256, and like Nvidia, look out below if this one breaks below that trendline support level. Amazon, ticker AMZN, has just been a name with continued relative weakness. All bounces have pretty much been sold right off, and now it's just a few dollars off of those 52-week lows. 86 is the next important spot, as the next leg down would start on a break below there. Tesla, ticker symbol TSLA, got real ugly real quick. The stock made new lows this week, including break and closes below the 200-week moving average and the 155 key level, which was the breakout trigger back in 2020. Now this one is oversold now and showing some bullish RSI divergence on the daily chart. So this can see a relief bounce next, but not much else to play off of other than that, and certainly does not look attractive here to long. Google, ticker symbol GOOG, is breaking down from its recent consolidation range as well. Around $90 per share is the next important spot, but below there can start a move to go revisit lows. Netflix, ticker symbol NFLX, this rejected right off that long-term gap fill and now gapped and broke below the $300 support level. The 50-day moving average is the next important spot to hold on this one to avoid more downside, as below there, downside will continue to a leg lower. And then Meta stock is the strongest of the bunch out of these mega cap stocks. It's still showing lots of relative strength, still making higher lows, and it's now bull flagging right below 124.5 resistance, which is also a key breakout level. As long as it holds above 113 to 114.5, this technical setup is strong and can be a main trading focus for longs on any market rallies and bounces ahead of us, with a breakup potential above that 124.5 level for a move that could result in a move up to the 128.5 gap fill level above. So now that we are past the major catalysts, the market is going to start looking forward to what's next, and coming up not before long is Q1 earnings season, which will start early to mid-January, just a few weeks away. There's going to be a ton of nervousness around these reports as rising rates and recessionary factors start affecting companies more and more going forward, and we could see some real ugly reports in Q1. A large negative factor along with this is that analyst earnings estimates are just simply too high for 2023. This is a report from Morgan Stanley showing the consensus earnings estimates versus what that company is estimating now. For 2023, the consensus has the S&P 500 at $231 per share versus Morgan Stanley's new estimate of $195 per share, which is a massive difference and a much more realistic number due to all the recessionary factors the economy is experiencing. Alright, so now we're going to take a look at a couple sector trade ideas for the week and weeks ahead. First up is the biotech ETF, ticker symbol XBI. This has been consolidating very tightly since mid-September. Both the 50 and 200-day moving average are also converged here along with price, which usually results in a big move once it chooses direction. Zooming in, this is also looking like a bear flag formation more than anything else. A break below 79 would trigger a breakdown, with target levels below at 77, 75, and below there, a break below 75 would start a much larger downside move. The next sector we're going to take a look at is energy with ticker XLE. This recently had a false breakout, formed a rounding top, and now is breaking down. It's currently bear flagging just below the 50-day moving average and looking primed for a move lower now. Watch the levels below at 83 and then 80.2, which also aligns with the 200-day moving average. That 80.2 spot would be the major level where if it does break below, it can start to move down towards those gap fill levels below there, which are laid out on my chart with those dotted lines. So that is everything that I'm watching moving forward and trade ideas for the week and weeks ahead. It does look like the market has started this next downside leg, but we will see on that S&P futures chart whether it can trigger a false breakdown reversal or if this continues lower, which does look like the likely scenario based on all of those setups we took a look at today. So hope you all enjoyed, hope I provided some value to you in this one. If so, make sure to hit that like button and subscribe button. It helps me out a lot and I would greatly appreciate it. For anybody interested in joining that private Discord chat, that is the first link down in the description for all my personal trade alerts, watch lists, and ask me any questions in there. I'll catch you all next time. Good luck trading this week and peace out.